My name is Talha Khan, and today I am going to present the topic of management accounting. I'll be presenting few topics related to management accounting. First of all, there is observation costing. This topic will cover observation costing, marginal costing, advantages, observation costing versus marginal costing, income determination in marginal costing, and income determination in observation costing. कौन कॉल पे है? ये मैं वो स्लाइड्स पढ़ रहा हूँ. There are mainly two techniques of product costing and income determination, that are observation and marginal costing. It includes observation costing, traditional costing, conventional costing, and full costing. Observation costing will continue as this is a total cost technique under which total cost, for example fixed cost as well as variable cost, is charged as production cost. In other words, the observation costing, all manufacturing costs are observed in cost of the product produced. In this system, the factory overhead are observed on the basis of predetermined overhead rates based on nominal capacity. Observation costing approach is same as used in cost sheets. Now, I'll be discussing marginal costing. An alternative to observation costing is marginal costing, or we can say variable costing or direct costing. Under this technique, only variable costs are charged as product cost and included in inventory valuation. Fixed manufacturing costs are not allowed to products, but as considered as the charges directly to profit and loss account of that year. Fixed costs also do not enter in stock evaluation. Both observation costing and marginal costing treat non-manufacturing costs. For example, administration, selling, and distribution overhead. Marginal cost is the additional cost of uh, producing an additional unit of product. It is the total of all variable costs. It is composed of all direct costs and variable overheads. An important point is that marginal cost per unit remain unchanged irrespective of the level of activity. The accounting system in which variable costs are charged to cost units and fixed costs of the period are written off in full against the aggregate contribution. Now we will know about the difference between observation costing and marginal costing. Treatment of fixed and variable cost. In marginal costing only variable costs are charged to products. Fixed costs are treated as periods cost and charged to profit and loss account of period. In observation costing, all costs, both fixed and variable, are charged to the product. A fixed factory overhead cost is observation in units produced at a rate predetermined. In observation costing, stocks are valued at total cost, which include both fixed and variable cost. The stock valuation in a marginal costing is lower than in observation costing. Measurement of profitability. In marginal costing, relative profitability of product department is based on study of relative contributions made by respective product department. The marginal decision is guided by contribution. Income determination under costing, marginal costing and absorption costing. The net profit under the two systems may be same or may be different. Difference in profit may be because of different bases of inventory valuation. In absorption costing, stocks are valued at total cost. Now, standard costing methods are topics covered. Standard cost, standard costing, meaning, steps, applicability, standard costing versus budgetary control, advantages and limitations, setting standard cost. Historical costing. In the initial stages of development of cost accounting, historical costing was the only system available for ascertaining cost. In historical costing, only actual costs are ascertained. Standard costing limitation of historical costing encouraged the development of a more satisfactory standard costing approach based on predetermined cost. It is special technique to control cost. Standard Similarly, and standard cost is the predetermined cost based on technical estimates for material, labor, and overhead for the selected period of time for a prescribed set of working. The standard costing is a technique whereby standard costs are computed and subsequently compared with the actual cost to find out the difference between the two. These differences are then analyzed to know the cost thereof so to provide a basic basis of control. The setting of standard cost for different element of cost. These are the steps in determination of standard costing. First of all, the setting of standard cost for different element, asserting actual cost, comparing standard with actual cost, analyzing variance for ascertaining reason, reporting of these variance and analysis thereof to management. Applicability of standard costing. In industries producing standardized products, in jobbing industries, it is not worthwhile to develop and employ a full system of standard costing. This is because in such industries, each job understand may be different from another and setting standard. Now the differences in standard and estimated costs are given in this table. The next is standard cost versus budgetary control. The establishment of predetermined target of performance, measurement of actual performance, the comparison of actual performance with the predetermined target, the analysis of variance between the actual and standard performance, the analysis of variance between actual and standard performance to take corrective measures where necessary. Now the points of difference standard versus budgetary control. These are given in table the two differences. Next is advantages of standard costing. Effective cost control help in planning, provide incentives, fixing price and formulating policies. Facilities delegation of authority, facilitates coordination, elimination waste. Then the next is limitations of standard costing. There are following limitation of standard costing. Standard costing is expensive and unsuitable. Staff may not be capable of operating the system. Our business may not be able to keep standard up to date. Inaccurate and unreliable standards cause misleading results. Operation of standard costing system costing control is a costly affair. Activity-based costing system. Activity-based costing system or ABC is a costing method that allocates overhead costs to products or services based on activities required to produce them. Steps in the system are to determine the key activities that incur cost in the production process, machine setup, quality control, and order processing. Assign cost to activities. Assign overhead cost to each identified activity. Determine cost drivers. Identify cost drivers for each activity, which are factors that cause cost change. Example of activity-based costings are given below. Step 1. In step 1, there is identify activities. Then step 2, assign cost to activities. And step 3, determine cost drivers. ABC costing numerical example is given as below, in which a company calculate the cost per unit of each activity. So the total overhead cost on table will be 34,000. Now the advantages of activity-based costing: improved accuracy. And the next advantage is better cost management, enhanced decision making, greater insight into profitability, and improved resources allocation. Variable costing and throughput costing in cost accounting. Both variable and throughput costing are alternative costing methods used for internal decision making. They differ in how they treat costs, especially fixed manufacturing overhead. Key features are as follows: product cost, period cost, and inventory valuation. Formula for variable costing method. Formula for variable costing method is given as in the slide. The advantages are internal decision making, avoid fixed overhead allocation issues, and focuses on cost behavior. Now the disadvantages are not gap compliant, ignores long-term cost and its application are decision making, analyzing short-term profitability. Throughput costing, also known as superior variable costing, is an extreme form of variable costing. It considers only direct material cost as product cost. Its key features are product cost, it only include direct material. Period cost, all costs other than direct material are treated as expenses. Inventory valuation is valued at direct material cost only. So the next is formula for calculation of throughput costing. This is the formula given for throughput costing. Advantages: focuses on bottlenecks, encourage management to focus on increasing throughput. Simplified costing by assigning only direct material. Highlight variable contribution emphasizes the incremental revenue. Its disadvantages are it ignores key cost, it is a short-term focus, and its application are used in theory of constraints, analyzing bottleneck and maximizing throughput. Now there is comparison of variable costing and throughput costing. This is the comparison given in table. Now moving towards the summary of variable and throughput costing. Summary is variable costing separate cost into variable and fixed categories, making it idle for short term. Throughput costing focuses exclusively on direct material, emphasizing the role of raw material in generating revenue. Both methods are powerful tools for internal management decision but are not suitable for external financial reporting. So that's all from my side.